Welcome back to FT Markets. We've seen quite an improvement in the eurozone peripheral countries such as Spain and Italy, at least if you believe markets. Borrowing costs for Italy and Spain have been coming down quite a lot recently. But what's most interesting, perhaps, is that Spain is actually now enjoying lower borrowing costs than its Mediterranean rival. With me to discuss the outlook for the eurozone periphery and the possible rating implications is Fergus McCormick, who's the head of sovereign ratings at DBRS rating agency. Fergus, welcome to the FT. We have, as our first chart, we have the pictures of the most important thing as far as the rating agencies are concerned, debt sustainability. Tell us, what's your thinking at the moment about debt sustainability and therefore the rating outlook, if you like, for Italy and Spain?
Well, we've had for some time now ratings of A low for both Italy and Spain with negative trends.
Right.
And the question now for us is what would induce us to either return those trends to stable or to downgrade the ratings. And we make a direct link between our credit ratings and our perception of debt sustainability.
All right, if you look at the chart, you suggest that debt sustainability is getting substantially better in Italy, which is the top line. Spain, not so much.
Well, it appears that the Italian debt to GDP ratio has actually stabilized at the current level.
You can see it in the top line, yeah.
But the Spanish debt to GDP ratio is going to continue to climb for at least 4 more years. So they have at least 4 more years of an adjustment. That's a very long time in a crisis.
What are you concluding then in terms of Italy versus Spain?
Well, we're very much in wait and see mode. It's actually an interesting comparison. Spain, I think Italy suffers from a largely dysfunctional political system, but very high public debt. But then in the case of Spain, they have a slightly more functional political system, but a much longer fiscal adjustment.
Okay, all right. I know you've subjected some of these projections to sort of shocks as well. Which is the sort of the most shock resilient?
Well, I think the main concern for us and the sustainability of debt to GDP is growth.
Yeah.
Now, debt to GDP is influenced by the public finances, it's influenced by the interest rate environment and other variables, but the most important by far is growth.
Okay,
so
let's just move on growth, because your second chart I know you've brought along is cost competitiveness. These are unit labour costs. And here actually we see quite a huge divergence between Italy in the green, this is improvements over the last decade, and Spain really doing quite well there.
Well, we are seeing improvements in productivity in Spain and Ireland and other countries, and we are seeing much lower unit labor costs. The cost of labor has actually declined quite significantly. The question is this going to be transmitted from the export sector to other parts of the economy?
For the growth.
Yes, exactly. And unfortunately, growth in Europe remains very lopsided, very fragile, and very uneven. So that we're seeing pretty strong export growth, but we're not seeing strength in either investment or consumption.
Does this make these sorts of charts make you more optimistic about Spain than Italy?
Not necessarily. Not necessarily. They both function with different dynamics. But the key point is for growth to be high enough and balanced enough to generate employment. We're seeing that in Ireland. We're not seeing it in Italy or in Spain.
Okay, our final chart, very quickly, is of the private sector deleveraging, and speaks exactly to your point. We've seen a huge deleveraging in Ireland, so presumably that means that's over, or at least largely over in Ireland. Spain also made quite a lot of progress. Italy, not so much.
That's right. The deleveraging continues in all of these countries. And I think the private sector debt, which is very high, is the biggest impediment to growth across Europe. Now we've seen great progress, I think, in Spain, where non-financial corporations have deleveraged by about 30% of GDP since 2009.
Right.
Well, that's very significant. But at the same time, they have a long way to go.
Okay, and Italy?
As well. Now the deleveraging has been less, but they're still not lending. And part of the reason is that Europe continues to suffer from economy-wide credit squeezes.
Okay, Fergus, thank you very much. So from what we hear from DBRS, quite a lot of progress. Italy and Spain, who's going to win this competition? If it's a competition, well, we may have to wait a few years yet.